Hello, everyone, and welcome to the Corporate Finance Update in the Finance Directors Seminar for November. I'm Matt Willmott, and I'm a Director in the Corporate Finance team at Francis Clark, and I specialise in mergers and acquisitions. I'm going to give you a brief update on the deal activity that we've been seeing over the last year, and then go on to talk about some of the changes in the budget and how that might impact deal activity going forwards. So, the year to date has been another challenging period for M&A. We've had persisting high interest rates, we've had economic uncertainty, and we've also had political uncertainty. So year to September, we're around 10% down on deal volumes, both in the UK and the Southwest. But that has completely changed in October. There was a huge rush of transactions as many business owners looked to sell and realise gains before the changes in the budget. I think as a firm, we did something around a dozen deals in that month, and the last completing about 10 p.m. The night before the budget. So a bit of a rush, but some very pleased shareholders. In terms of valuations, these have remained fairly steady this year at around an average of 6 times EBITDA, the same as last year, down from 7 in 2022. But I think this portrays quite a lot of complexity, and certainly we've seen a lot of divergence by sectors. So we've seen certain winners, such as financial services, business services, and industrials. And then on the other end, that have been more challenged, those that are more exposed to consumer confidence, so retail, hospitality, etc. We've also seen a bit of a trend with buyer caution persisting, where consideration is structured in a way that there is more on a deferred terms or perhaps an earnout. So when negotiating earnouts in particular, making sure they are achievable and getting protections in place has been really critical. We've also seen deals where companies' performance has fallen during a process, has had a big impact on the transaction. Buyers are taking action. Perhaps a couple of years ago, they would be more relaxed, but they are changing deals, they are chipping prices. And so that goes back to preparation, ensuring that when you go into a process, you are due diligence ready so that the management can spend time continuing to make the business profitable rather than being distracted by too much due diligence. However, we are also seeing for very high quality businesses, almost irrespective of sector, they are achieving premium valuations. So those with strong management teams, those that are perhaps market leaders, those that have very resilient cash flows are still doing very well when it comes to M&A. Now, in terms of the budget, the main one for business owners in terms of looking to sell is around capital gains tax, which we've seen increase from 20 to 24%. That's happened already. And we will see business asset disposal relief increasing from 10% to 14% in April, and then up to 18% the following April. So just looking at business asset disposal relief in particular, that move from 10% to 18% is an 80% increase in tax. And it wasn't too long ago where now it's the first 1 million, it was the first 10 million at 10%. So that's a huge reduction. So those selling at the smaller end are really taking the brunt of these changes. From a business perspective, we've seen huge changes and increases in the cost of employing people. So this is NI and minimum wage. It's going to impact every business, but across certain sectors, there's going to have a real acute impact. Things like perhaps those that are employing lots of staff at lower wages, those in the care sector, the hospitality sector. And certainly there's a transaction that I've worked on at the moment where in the care sector, where the profitability is completely wiped out and the deal has to be restructured. The key point here is ensuring that you fully understand the impact of these changes when they come through, revisit the budgets, revisit forecasts, have a look at your bank covenants. And if there are issues that you're likely to face, have a conversation with your bank early. And if you are looking at a transaction where there is an earnout that's linked to profit, really assess that impact and see how achievable those earnouts are. But ultimately, it's about coming up with a plan to try and mitigate it as best you can. Some good news. So for those business owners that are looking to sell to employee ownership trusts, the capital gains rate tax on that has remained at 0%. And so that differential now is quite substantial, even more than it was between the main rate and 0%. And so it's probably no surprise that we've seen probably 2 or 3 inquiries around EOTs in the last week. But some of the changes they have made are really to ensure that these rules aren't being abused and they're not being done for the wrong reasons and purely for tax reasons. So things like ensuring the sellers don't control the trust afterwards, ensuring the trust doesn't pay more than market value for the business. These are things that we've been advising and advocating for a number of years, so we do welcome these changes. For businesses looking at growth and raising finance, EIS and SEIS have been extended for a further 10 years, so that's further good news. And then not so good news, back to business property relief and the impact it will have on inheritance tax. My tax colleagues have covered how that impact may cover a huge range of businesses, and I think I'd re-emphasize what they've said in terms of making sure that you revisit your plans and look at the ownership structure as carefully as possible and do what you can while there's a window of opportunity. We do expect there to be a flurry of succession-related transactions coming through. So looking ahead, outlook, we remain cautiously optimistic. Certainly as we looked at the budget that's just gone, we were concerned that changes of CGT would be much greater than they were, and there remains some incentive to get deals done by March before business asset disposal relief increases. So it's worth about 40,000 on that first £1 million. But I think the key point here is that now that the changes have come through, there is a period of certainty for business owners. And over the past few years, various rumours ahead of budgets have led to a surge in transactions. But now these changes have happened, we hope that business owners will be able to plan and prepare for their exits and transactions at a time that suits them, the business and the market they're in, rather than being driven purely by tax change. In terms of the funding environment, this is very positive. So from a private equity perspective, they've still got huge capital deploy. And the feedback we're receiving is that actually they don't have enough quality opportunities to invest in. From a debt perspective, hopefully interest rates will continue to fall through 2025, and that should unlock some of those more leveraged transactions. And certainly we expect to see the alternative finance market still playing a key part in funding those transactions, offering a bit more flexibility. We expect to see the intensity of due diligence continuing. So 18 months, 2 years ago, this changed where buyer caution really took hold and more due diligence was being undertaken. And we expect that to continue. So again, ensuring that the business is due diligence ready and well prepared before it goes into a process. And finally, we expect to see continued positive interest from overseas buyers. So we have 3 or 4 transactions at the moment where we're speaking to US buyers. We have interest from Scandinavian buyers. There's various family offices and aggregators over there that all see the UK as a strong place to do business and make acquisitions. And we expect that to continue. And certainly from our role as M&A advisors in finding buyers for our clients, it's very much more a global exercise than purely just a UK to find those strategic buyers wherever they may be. And finally, just wrapping up a few key points and conclusions. It's been a fundamental change as a result of this budget, both for businesses and for business owners. Now is a time to really revisit that strategy and check that it's fit for purpose and take action as soon as possible. If you are looking at a transaction, really look at the components of value. So first of all, profitability. Is this a time to invest? Is it a time to look at profit improvement? Really scrutinize the P&L. Looking at the profit multiple, how can you make the business more resilient? How can you adapt to some of the changes coming through? Does that mean embracing more technology? And finally, on the tax perspective, look at the share ownership. Look at, is it fit for purpose? Go into a transaction with the best tax structure to minimize that tax leakage that you can. And finally, when it comes to data within a business, making sure that you use that as part of your strategy so you take informed decisions. Please listen to my colleague's presentation on data insights, which is next in this YouTube series. Thank you.